On the 6th of April 1917, the United States Congress voted to enter a war that President Woodrow Wilson had promised. Only months earlier, the country would never join. The official story is simple. German submarines sank American ships. American lives were lost. A telegram surfaced proposing a German alliance with Mexico against the United States. The nation, reluctant but righteous, answered the call. That is the version taught in most classrooms, and none of it is false. If you're enjoying this story so far, don't forget to hit the like button and subscribe. Drop a comment telling me where in the world you're watching from. I love hearing from you. But sitting beneath that political narrative is a financial one, and it involves a private banking house on the corner of Wall Street and Broad Street in Manhattan, a firm that by 1917 had become the single largest financial artery connecting the United States to the war effort of Britain and France. Its name was J.P. Morgan and Company, and by the time the first American troops boarded ships bound for the ports of France, the firm had already underwritten more than $2 billion in credit to the Allied powers, acted as the sole purchasing agent for British and French war orders on American soil, and staked its own institutional survival on an outcome that a German victory would have made catastrophic. This is not a secret. It is documented in Senate testimony, in the firm's own records, and in the findings of a congressional committee that spent 2 years asking exactly how close the interests of American finance had come to the decision to send American men to die in French trenches. What the committee found, and what it could not find, is the record this film follows. To understand how a private bank came to occupy this position, you have to understand what J.P. Morgan and Company already was by the time the war began. The firm traced its authority back to Junius Spencer Morgan, who had built a transatlantic banking relationship between London and New York in the 1850s, and to his son, John Pierpont Morgan, who by the turn of the 20th century had become the most powerful private banker in American history. Pierpont Morgan had personally organized the financial rescue of the United States Treasury during the Panic of 1895, assembling a syndicate of gold to prevent the government from defaulting. He had orchestrated the formation of United States Steel, the first billion-dollar corporation in American history. He had, during the Panic of 1907, effectively acted as a one-man central bank, summoning the heads of New York's trust companies into his personal library and refusing to let them leave until they agreed to a rescue plan. Pierpont Morgan died in 1913, the same year Congress created the Federal Reserve System, an institution partly designed to ensure that no single banker would ever again need to perform that role personally. His son, John Pierpont Morgan Jr., known as Jack, inherited the firm, and he inherited something else as well, a set of long-standing relationships with the Bank of England, with the French Rothschild banking interests, and with senior figures inside the British government itself that stretched back 3 generations. When the war began in August of 1914, those relationships were about to become the most valuable asset the firm possessed. At the outbreak of war, the American economy fell into a brief but sharp panic of its own. The New York Stock Exchange closed for 4 months, the longest closure in its history, because European investors were expected to liquidate American securities to fund their war efforts, and nobody knew what that selling pressure would do to prices. Cotton exporters in the American South, dependent on European markets, watched demand collapse. The federal government itself had limited tools to manage a financial shock of this scale, since the Federal Reserve had only been signed into law the previous December, and its regional banks would not open for business until November of 1914. Into this vacuum stepped the private banking houses of Wall Street, and none more prominently than Morgan's firm. Britain needed to purchase enormous quantities of American wheat, steel, chemicals, and eventually artillery shells and rifles, and it needed a way to pay for them without draining its gold reserves to nothing. France faced the same problem. Both governments turned to New York, and both turned specifically to the House of Morgan, because Morgan already had what no other American bank could offer: direct, decades-old lines of trust, with the British Treasury and with the Bank of England's governor, Montague Norman, a personal friend of Jack Morgan's partner, Thomas Lamont. In January of 1915, the British government formally appointed J.P. Morgan and Company as its sole purchasing agent in the United States for war supplies. This was an extraordinary arrangement. Every rifle, every artillery shell, every bushel of wheat, every bale of cotton that Britain bought from American suppliers now passed through Morgan's offices, and Morgan collected a commission on the transactions. Estimates of the total value of goods purchased through this arrangement over the course of the war run past $3 billion, an almost incomprehensible sum for the period, and the commission alone made the firm's war-era profits the largest in its history to that point. France signed a similar agency agreement soon after. The arrangement gave Morgan something beyond profit. It gave the firm a direct, continuous, granular view into the material needs of the Allied war machine, and it gave American manufacturers, from Bethlehem Steel to DuPont to the meatpacking houses of Chicago, a single, reliable customer whose orders kept factories running and workers employed at a scale the peacetime economy had never produced. American industrial output tied itself to the Allied cause not through sentiment but through contract, and the contracts ran through one address on Wall Street. Purchasing agency was only the first mechanism. Goods, however urgently needed, are useless without the means to pay for them, and by the autumn of 1915 both Britain and France were running short of the gold and dollar reserves required to keep buying at the pace their armies demanded. The solution Morgan proposed was the largest foreign loan ever floated in American financial history to that point. The Anglo-French loan of 1915, a $500 million bond issue underwritten by a syndicate that Morgan organized and led. The negotiations were not simple. American public opinion, and a meaningful portion of the American banking establishment, remained deeply uneasy about entangling the country's financial system in a European war it had pledged to stay out of. Secretary of State William Jennings Bryan, before his resignation over an unrelated dispute with Wilson earlier that year, had explicitly discouraged American banks from extending war loans to belligerent powers, arguing that money was the worst of contrabands because it commanded all other things. Wilson's administration eventually reversed that position, permitting the loan to proceed on the reasoning that it represented ordinary commercial credit rather than a violation of neutrality. The bond issue closed in October of 1915, and it was the first of several. By the time the United States entered the war in April of 1917, American banks, led by Morgan's syndicate, had extended roughly $2.5 billion in credit to Britain and France combined. Germany, by contrast, had managed to raise only around $30 million in the American market, hamstrung by the British naval blockade that made shipping and communication with German banking interests almost impossible, and by an American banking establishment that, Bryan's early objections aside, simply found the Allied cause more commercially and culturally congenial. This is where the financial record becomes difficult to separate from the political one, because by 1916, the House of Morgan was no longer a neutral lender watching a war from a safe distance. It was a heavily exposed creditor with a direct institutional stake in which side won. If Britain and France defaulted, or if Germany prevailed and the Allied governments that owed Morgan's syndicate billions collapsed or repudiated their debts, the firm faced losses large enough to threaten its own solvency and the solvency of the American banks that had joined its lending syndicates. Thomas Lamont, the Morgan partner who had become the firm's principal liaison to the British Treasury, wrote privately during this period that the firm's fortunes had become, in his words, bound up with the Allied cause. American farmers and manufacturers, meanwhile, had grown dependent on the wages and export income the British and French purchasing contracts generated, particularly in the industrial Northeast and the grain belt of the Midwest. A negotiated peace that left Germany intact, or an Allied collapse, threatened not just Morgan's balance sheet, but a swath of the American economy that had reoriented itself around Allied demand over the previous 2 years. None of this required a conspiracy to matter. It required only that the men making decisions about American neutrality, from the Treasury Department to the newspapers that shaped public opinion to the President himself, were operating inside an economy that had already chosen a side, whatever the official policy of neutrality still claimed. On the 7th of May 1915, a German U-boat torpedoed the British ocean liner Lusitania off the coast of Ireland, killing nearly 1,200 passengers, among them 128 Americans. The sinking produced immediate outrage in the American press and pushed public opinion sharply against Germany, though Wilson still resisted calls for war, extracting instead a temporary German pledge to restrict submarine attacks on passenger vessels. What the press coverage of the period rarely mentioned was that the Lusitania's manifest, only fully acknowledged decades later, included a cargo of rifle cartridges and artillery fuses bound for the British war effort, munitions that had very likely passed through the purchasing arrangement Morgan administered. Germany had in fact published warnings in American newspapers before the ship sailed, cautioning passengers that vessels flying British flags in the declared war zone were legitimate targets. The sinking remains, by any standard measure, an atrocity against civilians. But it is also a data point in the larger picture this film is tracing, the increasingly narrow line between commercial cargo and military supply, and between a private banking syndicate's balance sheet and the flow of material that was making the war possible for Britain and France to continue fighting at all. Wilson won re-election in November of 1916 on the strength of the slogan, "He kept us out of war," a promise his own party leaned on heavily, even as the president privately doubted how much longer neutrality could hold. Within 4 months of his second inauguration, the position had reversed entirely. 2 events are usually credited with that reversal, and both are real. Both are documented, and neither has anything directly to do with Wall Street. In January of 1917, Germany announced it would resume unrestricted submarine warfare, authorizing its U-boats to sink any vessel, including neutral American ships, found in waters around Britain and France. German naval commanders understood this policy risked drawing America into the war, but their calculation was that they could starve Britain into surrender before American troops could be trained, shipped, and deployed in meaningful numbers. Then, in late February, British intelligence intercepted and decoded a telegram sent by German Foreign Secretary Arthur Zimmermann to the German ambassador in Mexico, proposing that if the United States entered the war against Germany, Mexico should join the German side in exchange for German support in recovering Texas, New Mexico, and Arizona. The British passed the intercepted cable to Washington. It was published in American newspapers on the 1st of March, and it detonated public opinion in a way that the Lusitania sinking, 2 years earlier, had not quite managed to do. Congress declared war a little over a month later. Both the submarine policy and the Zimmermann telegram were genuine German provocations, not manufactured pretexts, and no serious historian disputes that they were the immediate, proximate triggers for the declaration of war. The financial relationship with Morgan's syndicate did not fire a shot, sink a ship, or write a telegram. What it did was ensure that by the time those provocations arrived, the American economy, the American banking system, and a significant portion of the American press had already spent 2 years financially and psychologically invested in an Allied victory, which meant the country entered the war's final debate already leaning in one direction. The war ended in November of 1918, and for more than a decade the financial questions surrounding American entry sat largely undisturbed. Then the Great Depression arrived, and with it a wave of public anger at bankers and industrialists that made the events of 1914 through 1917 look, in retrospect, considerably more suspicious than they had at the time. In 1934, the United States Senate authorized a special committee, chaired by Republican Senator Gerald Nye of North Dakota, to investigate the role of arms manufacturers and financial institutions in drawing the country into the war. The committee became known informally as the Nye Committee, and its hearings ran for nearly 2 years, pulling in testimony from executives at DuPont, Bethlehem Steel, and Remington, and eventually from the partners of J.P. Morgan and Company itself, including Jack Morgan and Thomas Lamont. Historian Charles Beard, whose work had already argued that economic interest shaped American foreign policy more than official rhetoric admitted, provided intellectual scaffolding for the committee's suspicions, though Beard himself was not a formal member. The phrase that attached itself to the hearings, and that has followed this story ever since, was Merchants of Death, a title borrowed from a 1934 book by journalists H.C. Engelbrecht and F.C. Hannigan that argued arms manufacturers and international financiers had profited from, and in some cases actively promoted, the outbreak and continuation of the war. If you're hooked on this story, make sure to subscribe and turn on notifications so you never miss an upload. Your support means everything, and helps me bring you more emotional stories like this one. What the Nye Committee actually found, when the hearings finally closed in early 1936, was narrower and murkier than the Merchants of Death label suggested, and that gap between the accusation and the evidence is itself part of the record worth examining closely. The committee established, without dispute, the scale of the financial relationship this film has already laid out. The purchasing agency, the size of the Anglo-French loan, the near-total absence of comparable German financing, and the private correspondence in which Morgan partners acknowledged how deeply their firm's fortunes had become tied to an Allied victory. Senator Nye argued this financial entanglement had compromised Wilson's neutrality long before the Zimmermann telegram or the submarine campaign forced the issue into the open, and that the administration's decision to permit war loans in 1915, reversing Bryan's initial objection, represented the moment neutrality effectively ended in substance while continuing in name. What the committee could not produce, despite 2 years of subpoenaed records and sworn testimony, was direct evidence that Morgan or any other financial institution had conspired to manufacture the war, suppressed peace negotiations, or exercised improper influence over Wilson's specific decision to ask Congress for a declaration in April of 1917. Jack Morgan testified plainly that his firm had lent money to Britain and France because they were creditworthy customers placing legitimate orders, not because the firm sought to drag the United States into combat, and no document surfaced contradicting that account directly. Historians who have revisited the hearings in the decades since, including biographers of the Morgan partners and scholars of Wilson's foreign policy, have generally converged on a similar conclusion. Financial interest shaped the environment in which the decision for war was made, narrowing Wilson's practical options and tilting American public and elite opinion toward the Allied side well before 1917. but it did not replace the immediate military provocations that finally triggered the declaration itself. The Nye Committee's most lasting legacy was not a verdict on Morgan's guilt, but a piece of legislation, the Neutrality Acts of the mid-1930s, which attempted to prevent American banks and arms manufacturers from ever again extending the kind of credit and material support to belligerent powers that had characterized the years before 1917, a legislative safeguard that would itself be dismantled piece by piece as the country's sympathies shifted again in the years leading up to the Second World War. The financial consequences of the arrangement did not end when the armistice was signed in November of 1918. The loans Morgan's syndicate had organized during the war were only the beginning of a much larger debt structure. By the early 1920s, European governments owed the United States, through a combination of private banking syndicates and direct intergovernmental war loans arranged by the Treasury, more than $10 billion, a sum that dwarfed the original Anglo-French loan, and that European economies, devastated by 4 years of industrial-scale destruction, had little realistic capacity to repay. Germany, saddled simultaneously with reparations obligations imposed at Versailles, found itself caught in a circular arrangement. German reparations payments flowed largely to Britain and France, who used a portion of those receipts to service their American war debts, which in turn had originally financed the war effort that produced the reparations demand in the first place. American banks, Morgan's firm prominent among them, stepped back into this cycle in the mid-1920s through the Dawes Plan and later the Young Plan, both of which restructured German reparations with fresh loans arranged substantially through Wall Street. Thomas Lamont, the same Morgan partner who had negotiated British financing during the war, served as an American representative in shaping the Dawes Plan's terms. The firm that had financed one side of the war now found itself financing the debtor whose payments were needed to keep the entire post-war financial architecture from collapsing, a closed loop of credit that historians have since identified as one of the structural fault lines that contributed to the global financial fragility of the late 1920s, fragility that would help produce the crash of 1929 and the depression that followed. The institution at the center of this story did not emerge from the war unchanged, and neither did the country's tolerance for the kind of private financial power the House of Morgan had exercised. The same wave of Depression-era anger that produced the Nye Committee also produced the Glass-Steagall Act of 1933, which forced a legal separation between commercial banking and investment banking that no American financial institution had previously been required to observe. J.P. Morgan and Company was directly affected. The firm split in two, with the commercial banking business retaining the Morgan name and a new investment banking firm, Morgan Stanley, spinning off in 1935 to carry on the securities underwriting side of the business, staffed in part by Morgan partners who had helped structure the very war loans the Nye Committee had spent 2 years scrutinizing. It is worth naming directly what this reform was responding to, because the connection is rarely stated plainly. Congress had watched a private partnership, answerable to no shareholders and disclosing almost nothing to the public, act simultaneously as a sovereign government's purchasing agent, its principal creditor, and a determining influence over which American industries prospered during the most consequential war the country had yet fought, all while facing no regulatory oversight resembling what a bank of that scale would face today. The legal architecture built in the 1930s and expanded further after the Second World War through the Bretton Woods Conference of 1944, which established the dollar and the newly created International Monetary Fund and World Bank as the framework for post-war international finance, was in substantial part an attempt to ensure that no single private firm could again occupy the position Morgan's had occupied between 1914 and 1917, simultaneously banker, arms broker, and de facto extension of a belligerent government's treasury operating out of an American address. The commercial banking half of the original firm continued under the Morgan name for decades, merging in 1959 with the Guarantee Trust Company to form Morgan Guarantee, and eventually, through a series of mergers in the late 1990s and 2000s, becoming part of what is today J.P. Morgan Chase, the largest bank in the United States by assets. The Glass-Steagall Wall that had separated commercial and investment banking after the 1930s reforms was itself repealed in 1999 under the Gramm-Leach-Bliley Act, permitting the kind of combined commercial and investment banking operation that had defined the original House of Morgan to legally reconstitute itself, this time inside a publicly traded, shareholder-owned corporation subject to disclosure requirements that would have been unimaginable to Jack Morgan's generation. The archival record of the war years themselves remains scattered rather than sealed. Much of the Morgan firm's wartime correspondence survives in the Morgan Library and Museum in New York, and in the papers of Thomas Lamont held at Harvard's Baker Library, both accessible to researchers, which is itself worth noting, since it undercuts any suggestion that the firm's role has been hidden from history rather than simply absent from the version most people are taught. The Nye Committee's own hearing transcripts, running to thousands of pages, remain in the National Archives and have been available to historians and journalists for nearly 90 years. What has kept this story out of general circulation is not suppression in any deliberate sense. It is the ordinary machinery of how national narratives get built, in which a clean story about German aggression and American resolve travels further and requires less specialized financial literacy to absorb than an account involving syndicated loan structures, purchasing agency commissions, and the balance sheet exposure of a Wall Street partnership. Return for a moment to the choice the historical record actually presents, rather than the choice a tidier story would prefer. It is not a question of whether Morgan's firm forced the United States into a war it would otherwise have avoided, since the documentary record does not support that claim and the Nye Committee, for all its suspicion, could never produce evidence for it either. It is a narrower and in some ways more unsettling question. Whether a private banking partnership's decision to finance one side of a foreign war, made for ordinary commercial reasons involving creditworthiness and existing relationships, can reshape the practical range of choices available to a government that still believes, and still tells its public, that it remains neutral. By 1917, roughly $2.5 billion in American credit sat on the Allied side of the ledger, and roughly $30 million sat on the German side. Farmers, steelworkers, and munitions plants across the American Northeast and Midwest had spent 2 years filling British and French orders. A default or an Allied defeat would have meant not just Morgan's losses but a contraction across the American economy that no elected official wanted to be responsible for explaining. None of this required Wilson to be a puppet, and no serious historical account treats him as one. It required only that by the time the Zimmermann telegram and the resumption of unrestricted submarine warfare forced the final decision, the American economy had already spent 2 years quietly voting for one side, and the war declaration that followed in April of 1917 ratified a financial commitment that had, in practical terms, already been made in the boardrooms of a private bank on Wall Street more than a year earlier. The country entered the war because Germany gave it cause to. It entered that war already leaning toward the side its own bankers had bet on, and that lean, quiet, undramatic, and almost entirely legal is the part of the record the standard account leaves out. There is a version of this story, popular in certain corners of the internet long before this film was made, that turns Jack Morgan into a villain pulling strings behind a curtain, deciding alone in a private study that American boys would die so that a Wall Street ledger could balance. That version is dramatically satisfying, and it does not survive contact with the actual documents. Jack Morgan was, by the testimony of nearly everyone who dealt with him, a conventional, somewhat unimaginative banker who had inherited a set of relationships built by his father and grandfather and who applied ordinary commercial logic to an extraordinary situation. He extended credit to customers he judged creditworthy. Those customers happened to be fighting a war. There is also a version of this story that treats the financial dimension as a footnote, a minor detail beside the moral clarity of stopping German aggression and answering the sinking of American ships. That version is more comfortable, and it is the one taught almost everywhere, but it requires ignoring $2.5 billion in credit, a formal purchasing agency, and a congressional committee that spent 2 years and thousands of pages of testimony concluding that the financial relationship mattered more than the official story allowed. The honest account sits uncomfortably between these two poles. A private bank's commercial decisions, made for reasons that had nothing to do with patriotism or malice, quietly narrowed the range of neutral choices available to an elected government, long before that government's hand was forced by torpedoes and telegrams it did not write and could not control. What makes this particular thread worth following, more than 8 decades after Jack Morgan sat before Senator Nye's committee and explained his firm's wartime lending in the plain, procedural language of a banker discussing accounts receivable, is how little the underlying structure has changed. Sovereign governments still finance wars through private capital markets. The banks that arrange sovereign debt still have, by the nature of the transaction, a direct financial interest in the survival and the victory of the governments they lend to. The line between a neutral creditor extending ordinary commercial credit and a financially interested party with a stake in a specific military outcome remains exactly as difficult to draw today as it was in 1915, when Bryan warned that money was the worst of contrabands and Wilson's Treasury decided, under commercial and diplomatic pressure, that a $500 million bond issue did not count as one. The neutrality acts that emerged from the Nye Committee's findings were designed to close that gap permanently. They were dismantled within a few years as American sympathies shifted again toward Britain in the late 1930s, and Franklin Roosevelt's Lend-Lease program of 1941, this time conducted openly through government channels rather than a private banking syndicate, resumed the same essential function the Morgan firm had performed a generation earlier. keeping an embattled Britain financially afloat before the United States had formally entered the fight. The mechanism recurred because the underlying problem recurred. A nation without deep enough reserves to fight a prolonged industrial war needs outside capital, and the capital rarely arrives without the lender acquiring an interest, however quiet, in how the fighting turns out. The building that once housed J.P. Morgan and Company still stands at the corner of Wall and Broad, its limestone facade still bearing the pockmarks from a 1920 bombing that killed 38 people and injured hundreds more outside its doors, an attack whose perpetrators were never conclusively identified, but was widely attributed at the time to anarchists, angered by the very concentration of financial power this film has traced. The firm's name now belongs to the largest bank in the country, itself the product of the very consolidation the Glass-Steagall reforms were designed to prevent, and that later deregulation eventually permitted again. The ledger that recorded $2.5 billion in Allied credit against $30 million in German credit no longer exists in any single physical form accessible to the public in full, scattered instead across the Morgan Library, the Baker Library at Harvard, and the National Archives holdings of a Senate committee that asked the right questions in the 1930s and received answers thorough enough to establish the scale of the relationship, if never quite conclusive enough to settle what that relationship had actually caused. That is where the record stops and where the standard account, the one about German aggression and American resolve, quietly takes back over. Both accounts are, in their own way, true. The gap between them, the years of purchasing agency commissions and syndicated loans that came before the telegram and the torpedoes that everyone remembers, is the part of the ledger this film has tried to put back on the page. None of this diminishes what the soldiers who crossed the Atlantic in 1917 and 1918 actually did, or why they believed, standing on the deck of a troop transport, that they were doing it. Most of them had never heard of the Anglo-French loan and would not have cared about a purchasing agency commission if they had. They answered a call framed in the language of democracy and self-defense against an aggressor that had in fact sunk their ships and proposed carving up their country's southwestern border with a foreign power. That call was genuine, and the men who answered it, most of whom never came home rich and many of whom never came home at all, deserve the plain historical record of what they were told and why they believed it. But a full accounting of how a reluctant, officially neutral republic arrived at that call in the first place has to include the 2 years before it, the years in which a private Wall Street partnership, acting well within the law and for reasons any banker of the period would have recognized as sound business, helped determine which side of a European war the American economy, and eventually the American government, would find itself standing on. The Senate committee that investigated this in the 1930s, over 2 years and thousands of pages of sworn testimony, did not conclude that Morgan started the war. It concluded something quieter and, in its way, more durable, that neutrality, once a nation's banks have chosen sides, is a policy that survives mostly on paper. The paper said neutral. The ledger, for 2 years before Congress ever voted, did not. Thank you so much for watching until the end. If you loved this story, check out the other videos on your screen now. I think you'll really enjoy them. And don't forget to subscribe if you haven't already. See you in the next story.